Welcome to another edition of Market Moves. My name is Vincent Scarsella, Head of Research and Investment Development at Sgroi Lawley. With the second quarter of 2025 in the books, today we will be discussing what happened during the eventful 3 months in which financial markets faced a dynamic environment shaped by shifting monetary expectations, ongoing geopolitical tensions, and evolving economic data. After a turbulent start in April, which saw all major indices post double-digit negative returns, markets regained their footing. As on April 9th, President Trump announced that he would be delaying reciprocal tariffs until July, which ignited one of the biggest short-term rallies in history and propelled the S&P 500 to hit a new record high on June 27th. After the announcement, stocks exploded to the upside. From April 9th to June 30th, the Nasdaq gained 33.6%, while the S&P and small caps rose 25% and 24% respectively. The Dow, although lagging, still rose an impressive 17.6%. When all was said and done, the S&P gained 10.94% for the second quarter and saw a new record closing high, while the Nasdaq saw an even more impressive 18% gain. The Dow rose 5.5%, and small caps closed out the quarter with an 8.5% gain. International markets continue to chug higher, returning 12.3% for the quarter, and year-to-date continue to outperform U.S. markets, with the index up 18.3%, while the S&P 500 is up 6.2%. International markets have lagged the U.S. market for quite some time, and if we go back to 2009, the S&P 500 is up 829.3%, or an annualized return of 14.47%, which is more than double the international market's return of 209.6%, or an annualized return of 7.1%. Finishing up equity markets, it was growth and growth-oriented sectors that outperformed in the second quarter. In a sharp reversal from the first quarter, the Russell 1000 Growth Index rose 17.8%, while the Russell 1000 Value Index gained 3.7%, or a 14% spread between the two indices. Much of this can be attributed to those Mag 7 names coming back from steep losses in Q1 and the rotation into growth from value as investors piled into risk-on assets. From a sector standpoint, 3 out of 11 outperformed the S&P, with technology, industrials, and communication services rising 22.8%, 12.9%, and 12.8% respectively. With markets rising on positive economic data, forecasted Federal Reserve rate cuts, and delays in tariffs, more defensive sectors underperformed, as consumer staples and healthcare were in the red, and energy was the biggest laggard, down 8.5% for the quarter. Much of this was attributed to weakness in oil prices, as although there were occasional spikes in oil prices from geopolitical events, this was short-lived and overshadowed by OPEC cutting its global oil demand projections and the IEA reducing its oil demand forecast for 2025 and 2026. Turning to fixed income, most of the bond market remained in the green in the second quarter, despite elevated volatility that sent longer-term yields higher, as investors initially feared tariffs would cause a spike in inflationary pressures and in turn cause the Federal Reserve to continue to pause on cutting interest rates. After the announcement to delay reciprocal tariffs, volatility and yields subsided somewhat, and the 10-year Treasury note ended the quarter at 4.23% after climbing as high as 4.58% in May. The Barclays Aggregate Bond Index saw a gain of 1.2% for the quarter, while 7 to 10-year Treasuries rose 1.4%. High yield saw the largest return at 3.5%. Long-term fixed income, as it is more prone to interest rate volatility, ended the quarter in the red, down 2%, although well off the lows when it was down over 7% in the middle of May. Thank you for tuning in to this edition of Market Moves. If anyone has any questions, please do not hesitate to call your advisor or visit our website at sgroilawley.com.